So welcome everybody. I hope you've signed on. I've moved these sessions a little bit later to 5 o'clock. So hopefully some of you are, if you are back in the office and back at work, you're able to get home and follow these live events. This is actually the first of 4 live events that I'm going to be hosting around managing your credit, because I want you to have power over your credit, not be overpowered by it. And we do this by understanding the difference between good credit and bad credit, and also making the most of the finance that we can access, hopefully mostly the good credit. So this series is part of a campaign by Capitec called, and you will see it there, Living Better Starts With whatever it is your goal is. So your goal could be buying a home. We're going to be talking about home loans today. It could be about paying off your car. It could be about closing your credit card, for example. Whatever that goal is, I want you to share that with me in the comment box today. In fact, I must make sure I've got my little comment box open so I can keep track of all of your comments. And I want you to share it with me because there are prizes to be won. So not only am I going to be giving away a copy of my book at each live event. Let me see, there you go. It's My On Money, My Money Questions Answered. So this book was really written with all of my followers in mind, because all of you who send me questions, I land up writing about them and I answer them, and it's in this book. So I'm going to be giving away a copy of this to somebody today. But not only that, there is also a grand prize to win. So over this month of the Living Better Starts With campaign, Capitec is sponsoring a 10,000 Rand prize to one lucky person, and that can go towards the goal that they've identified. And there's a one-on-one session with me. Now, this is actually quite an unusual prize, because if any of you have ever approached me, you'll know that I don't do one-on-one sessions. I just cannot fit it into my chaotic life and schedule. But I am going to be able to spend an hour with one of you and help you reach that goal, along with that 10,000 Rand from Capitec. So to stand to win that grand prize, there's a couple of things you need to do. You need to watch these events and make sure we're tracking you, so we'll know that you've been in all of them. We need you to share your goals on social media. You can do it on the Facebook page, on Twitter, Instagram, wherever it is, but make sure you use the hashtag Living Better Starts With, and make sure that you include my handle, Maya on Money, so we know that you're part of my campaign. You also need to sign up for the Capitec Credit Bootcamp series of emails. You're going to get the little link is going to be posted on the Facebook page now. So please make sure you keep up with that. This is a series of articles that Capitec has put together to try and help educate people about making good choices and healthy choices around credit. So hopefully that all that's inspired you all, and I hope one of you are going to be the lucky winner of that 10,000 Rand. But now on to the topic of the day. We're going to be talking a little bit about home loans. But before I start on that, I really have positioned these series of discussions around understanding good debt versus bad debt. And people always say to me, Maya, what is good debt and what is bad debt? For me, good credit, healthy credit, is credit that you take on to achieve something that's going to move you forward in life. So a home loan would be a really good example of that. This is a home. It's going to put a roof over your head. It's also an asset. It will grow with value. It could be an investment for you if you rented it out. It's going to bring wealth to you. A car literally moves you forward. So a car may be something that you need to get to work, to fit your kids, to take them to school, all of those things. In South Africa, we don't have a great transport system. So yes, I would say a car falls under good credit. But a car that gets you from A to B is good credit. A car that is a lifestyle choice and a statement to your friends and puts you under financial pressure, that is not good credit. For me, it's also about how much you spend on the car and the affordability that would fall under my good and bad debts. Another good example of good debt would be student loan. Going and studying, learning, educating yourself, putting yourself in positions to get a better job, to earn more money, even starting a business. Those are good credits. And we're going to be really discussing this over the next couple of weeks about how to engage with that sort of credit and how to make really good choices around it. But today, it's going to be about home loans. And the reason I wanted to kick off with home loans is twofold. One, it's one of the most common questions I get from people. In fact, I've written quite a lot of articles about it quite recently, simply because we're getting so many questions about it. But the second reason is that Capitec actually launched its home loan offering today, I think, or yesterday. So I thought it would kind of tie in quite nicely, seeing as this is part of their campaign. So when I look at home loans, one of the things that I find, if I have to say the mistakes people make, is that most people are not ready for the true cost of home ownership. Because to owning a home, buying a home, the costs, the transaction costs, and then the ongoing expenses of running the home, it can become really, really significant. And I want to share with you a slide here quickly, just to give you an idea of the kinds of costs that you can incur when you buy a home for the first time. I'm on the wrong, this is going to give away my next one, but it's fine. I'm going to quickly skip up. Don't look at that too much, because we're going to talk about that a little bit later. Oh, this would happen, of course. There we go. This is what I wanted to show you. This is the graph I wanted to show you. So this is an example of a transaction costs on R1 million sectional title property. The costs to buy the house is about 53,000 Rand. 53,000 Rand. I don't think most people actually realize that. Most of it, by the way, goes to lawyers, bond registration costs, and property transfer costs. I'm not even talking about transfer duty, because that's actually not a problem at R1 million. It only affects you afterwards. So you need to have at least 54,000 Rand over and above the deposit that you would be wanting to put down. So you kind of need a war chest, I would say. If you want to put a 10% deposit down on your house, which you often need, the banks often require that, plus cover all these transaction costs, you need around 15%, maybe even 20% of the value of your purchase before you can consider buying a home. And then there's the ongoing running costs. Let me tell you, if you've never owned a home before, it is a shocker. All right, you can pretty much, your mortgage is one thing, but your building insurance, household insurance, rates, levies, water, electricity, maintenance, and let me tell you, those rates, electricity and water, are going up at a rapid rate. I mean, it does depend where you live at the moment as to what your rates are, but I am getting so many complaints from people about rates, especially older people. They've lived in the house for so many years, and suddenly the rates have just escalated, and they actually can't afford to keep the home anymore. So these are big running costs. I would say, if your mortgage is 8,000 Rand, expect at least another 4,000 Rand. So 50% of your mortgage, add that to the running costs, and understand that this is actually what it costs to start owning a home. So owning a home is not just something you wake up tomorrow morning, you see a nice house, you say, let me go for it. It does require a plan. And I want to share with you a kind of strategy that I always follow, and that is what I always advise to people. I say to them, if you're wanting to buy a home and you're wanting to become a homeowner, rather live like a homeowner before you buy. So what I mean by that is, go find out, what will that mortgage cost me? What will my rates, electricity, all of those things cost me versus what I'm spending at the moment? If you're living at home, of course, at the moment with your parents or something, brilliant, because you can save a lot of money. And start living like the homeowner. Start living as if you are already in the home. By what I mean by that is, whatever that cost difference is, start saving it. Start putting it out of your account at the beginning of the month and start putting it away. If you find you cannot do that, you're not ready for that home. So it really does stress test your budget before you commit. But it also does two other fantastic things. First of all, you save towards your deposit by doing that. Okay, so you can put down that 10% deposit plus all the extras you need for the transaction costs. But it also makes you're able now to go to the bank and say to the bank, I have lived as a homeowner. I understand the cost of home ownership. I can afford this, and you're likely to get a much better interest rate and definitely qualify for that home loan. So I think that for me is really the main tip that I want to give you today around if you are looking at purchasing a home. So don't just rush into it. Have a plan. And the other thing that I'm picking up at the moment, another big question I'm getting is is this the right time to buy property? Because, of course, we've had this massive rate cut. I mean, prime rate was 10% at the beginning of the year. It's now at 7%. So it's effectively a 30% decrease in the cost of credit. This is suddenly making home ownership a lot more affordable for people who are starting to say, well, hold on, my mortgage is going to be quite similar to the rent I'm paying. So I want to just give you a little bit of word of warning. These rates are not here to last. We are at the bottom of an interest rate cycle, which means that maybe there'll be another cut if things get worse. But most economists are expecting us to increase interest rates in about 2 years' time. It'll be gradual. It's not going to jump back up by 3%, but it will be gradual. So if you are buying now, you need to buy understanding that you're going to have to tolerate rate hikes. We can perhaps in the Q&A, if anyone wants to understand, we can get into discussion about fixed and variable rates, but you need to know that you can afford to accommodate future rate increases. So what I would do if I was buying a house now is I would say, find out what would my mortgage be if it went back to the interest rates it was in January. So if we went back up to 10%. And if I can afford that now, why don't I start right from the beginning paying extra into my mortgage? Because it does two things. It makes sure that when those rate hikes start, I can afford it. And secondly, it helps me pay off my mortgage sooner. Exactly the same thing applies if you are already a homeowner. If you've been owning a home for a couple of years, you saw and you can afford it. Of course, I'm now assuming that you can afford this. You haven't been hit by the COVID cuts in pay. But if you can afford it, try and keep your repayments the same day as they were in January, because it will, keep your budget, bulletproof your budget from future rate cuts, but also it will help you pay off your mortgage earlier. So what I'm going to do is I'm going to now share with you 2 slides. I'm going to take you through this. This is a little technical, but I really want to spend time on this because it is something people really don't understand. And this is amortization and why paying extra into your mortgage has such a massive impact. So because we don't always understand the way our home loans are structured. So in this example, okay, so I've got an example here of a home loan. This is a R1 million home loan over 20 years with an interest rate of 8%. You will see, so I see there's a mistake here. It says annual repayment. It's actually monthly repayment. So in month 1, your mortgage, look at that. Each month, your mortgage is exactly the same. Every month, it's 8,364 Rand. It is identical sorry, that's going the wrong way. Every single, my mouse is misbehaving. Every single month, you pay exactly the same amount of repayment. That's your monthly repayment. What is not the same is what goes to interest and capital. That is what varies every month. And that is what we talk about amortization, the way that this amortization works. So in your first month, remember you started off with R1 million. On that, 6,666 Rand of your 8,300 goes to interest. A tiny little 1,697 Rand goes to capital. So your balance at the end of that month only reduces by the amount of capital you're paying in. So you're barely off R1 million. By month 60, so if you have a look at month 60, which is about 5 years into your home loan, you will see that you are still paying significantly more interest than you are capital. So most of it's going to interest, because by this stage, your balance has come down to about 875,000 Rand, but the interest charge on that is 5,800 Rand. So what's left from your mortgage, monthly mortgage payment is only 2,500 towards capital. It is only in month 136, which is about 11 years into your mortgage, that your interest and capital are actually equal, that you're paying an equal amount into interest and an equal amount into capital. And that's, your balance has now come down to 626,000. And in the last month, this is the month before you pay off. This is 239 months in. You will see that very little goes to interest because your balance is now being reduced to 8,300. So most of it goes to capital. And that's what we talk about when we talk about amortization. So now you can understand why it feels like in the first 5 years, especially, you're getting nowhere. You've paid in all of these installments, and yet it's just, inching down bit by bit by bit because so little is actually going to capital. So what happens if you pay extra? In this example, I've just said, what if you increased your payment just by 10%? So on this example, of course, you would have, because your mortgage was 8,300 odd, you'd pay an extra 836 Rand, which means that your monthly mortgage, not annual, monthly mortgage repayment would be 9,200. So you're paying in more than the bank wants you to. So remember, in the first month, on the million Rand, your interest will be the same, but you're paying that little bit extra into capital. So at the end of that first month, instead of your balance being 998,000, it's already starting to drop by that additional payment that you've put in, because every Rand of extra payment you put in goes straight to reducing that outstanding balance. In month 60, so we're 5 years in, you're paying interest, you'll still have interest, but you're paying in a lot more capital. If you can remember, you were only paying in 2,500 Rand capital. Now 3,700 is going to capital. And look at the impact. So if you were not paying an extra, your balance would only be 875,000, but already it's starting to come down a lot quicker, 813,000. So you may still feel after 5 years it's not coming down that quickly, but it really, really starts to work with you over time, because by that month 136, remember the repayments were about 4,000 into each. Here, you're paying only 3,000 into interest and over 6,000 Rand into capital. And look at the impact that's now having. So by year 11, if you were not paying an extra, your balance would only be 626,000 Rand. But because you've been paying an extra, you've already paid down and you only owe the bank 441,000 Rand. So what happens? By month 194, which is about 16 years, just around 16 years of your bond, you're actually paid off. So in that year, had you not paid extra, you would still have a balance of 330,000. Instead, you are about to pay it off with your last installment. So that means you pay off your bond just by paying an extra 10%. You pay your bond off 4 years earlier and you save a massive 214,000 Rand in interest. So I hope that's kind of helped you guys to understand the difference on why it's so important and why I always talk about the benefits of paying an extra. And it's not about taking every last cent that you have and hitting your mortgage. It's just about committing to that extra 10%, just knowing that that will do the job for you. So that's kind of what I wanted to share with you from my perspective and the questions that I pick up. But I now want to really start moving through to questions that have perhaps come through. So, I've got a lot. So I'm going to be busy here scrolling down. So, okay, so one person's goal is to pay off their car. That's fantastic. But let me see. What I would like to do to handle is some questions that are coming through. Let me just see what other questions. You can also welcome to post questions that you want to. Let's see what other questions are coming in. So a lot of you have got great bets. Start better in paying off my car. Use the installment to save 20% down payment for rental property. Nice one. Swapping a depreciating asset for an actual asset. Yeah, a lot of you have got some great ones. Here we go. I asked a bank to negotiate their initiation fee and they refused. I was prepared to pay a deposit, but they didn't want to give me access to those funds. It's Standard Bank, by the way. Okay. So the initiation fee, that's an interesting question. So the initiation fees, I showed you there's about 6,000 Rand. And it is interesting. They do not negotiate that. I haven't come across banks that negotiate that initiation fee. So their argument is there's actually a lot of paperwork involved, blah-de-blah, whatever. But we don't find that they often negotiate their initiation fees. But what they do negotiate, and in fact, Capitec is doing it. Capitec is offering a 50% discount on bond registration costs. So that is definitely something that you can use. And I see also that paying a deposit and whether or not you can access those funds. So if you pay a deposit, it means that you are financing over a smaller amount. So there's two different ways. You could say, I'm going to take the R1 million loan and I'm going to get that as my full access facility. And in my first month, I put the deposit in. Okay, but I've actually got the finance facility for the full million, but maybe I put my 10% deposit down in month 1 or month 2. I immediately have reduced my balance down to 900,000, but I actually have access to that 100,000 Rand still. If, however, I say I'm putting down a deposit and I'm only going to finance upfront 900,000, that is all your facility. So it's very important to understand how that access bond actually works. Sherilla wants to know, is it a good thing to pay a deposit towards buying a house? Absolutely. Well, I think hopefully, Shirley, you've understood just from what I've just shown you, that the quicker and the more money you're putting in, the less interest you pay. So remember, it's that interest bill that really, really hurts you over time. So if you're putting a deposit down, A, you're likely to get a better rate with the bank, and B, you're paying them a lot less interest, because interest is money down the toilet. Right. Do things like switching off your geyser when you're not at home and switching off your plugs impact your cost on rates and levies? No. Good question. So rates is a tax. It's actually a tax that is charged by government. It's just one more tax, one more, like they put VAT on everything, they tax our houses. And rates are based on how many bedrooms you have, how many bathrooms you have in the square meterage and your area. So it doesn't matter what you do, you're still going to have to pay those rates. Levies, there's an element, if you're living in sectional title, of levies where that goes towards the maintenance of the entire sectional title. What does change is your electricity bill. But in most cases, that's what you have control over. And many places now have prepaid electricity, especially in sectional title. So you would be managing that. And that's really the only thing that you could save money on. Let's see, what other questions have we got coming through here? Which is better option, paying extra with a lump sum or extra on a monthly installment? Okay, Shola, another good question. They actually have, when it comes to debt, credit, banks compound daily. They actually calculate debt daily. When we invest with them, they compound monthly. But when it comes to lending money to us, they compound daily, which means actually, even if you're paying your bond one day earlier, it actually saves you money. So if you are, say, for example, you want to put 2,000 Rand extra into your bond every month, do you save it up during the year and put 24,000 Rand at the end of the year? No, you would actually be better off putting 2,000 Rand every single month in, because you're saving interest immediately. By the way, this is a little bit different with car finance. And I have, so please watch out for I'm not going to be doing car finance on this live thing, but watch out on my website, because car finance acts a little bit differently. But actually, the sooner you're able to pay in that little bit of extra, it helps tremendously. Does age impact the interest rate I get from the bank? So that's a very, very interesting question. So your age per se doesn't necessarily. So it's not like, well, let me put it this way. It's all about your ability to earn income and your credit record. So why I say ability to earn income, if you are 60 years old, they're very unlikely to give you a mortgage, because what is your chance of being able to work for the next 20 years? So that would affect your bond application. If you're very young and you're just 20 years old, you maybe haven't built up a credit record enough. You haven't built up enough banking behavior to get a really good interest rate. But what I can say is, what I have found, and I must tell you a wonderful story, is that people who may have taken out their mortgage when they didn't really have much of a credit record yet, they hadn't developed a lot of history for the bank. And so they paid a little bit more than they perhaps could have, or should have, should I say. 2-3 years into your mortgage, you have now built up a better credit record. And the bank can also see that you're paying your mortgage off well. You could go and ask to negotiate your interest rate. I actually have a follower who did just that. He approached me, and what happened is another bank actually offered him a better interest rate. And I said to him, before you move, because there's all sorts of costs in moving, I said, go back to your bank and see if they would match that. And they did. So it's definitely worth it if you have, if your credit record's improved over the last few years, go back and ask your bank if they'll negotiate the interest rate. Is it a good idea to save your emergency fund in your bond account? Very good question as well. We're getting such good questions. Okay, so I have a dual strategy. So for me, I've built up probably close to 6 months of my emergency fund. And the reason for that is I'm self-employed. So I need to know that, that I've got some safety measure. For many people, 3 months may be sufficient. But there are two different types of emergencies. One is you're having a really bad month, the tires burst, the dog got sick, the child got sick, and you've got some bills to pay. That you just need to be able to access quite quickly. And for that, I tend to keep that in a sort of 32-day notice account, because I can settle it on my credit card and immediately pay it out of I can give notice on my 32-day account or my 7-day notice. So I like to get a little bit of interest on that, but my main need is to be able to access that quite quickly for the smaller bills. But when it comes to that bigger amount, that amount that's going to have to carry me for a few months if I can't work or something happens, that then, it does seem to make sense for me to put that in my bond and help me reduce my interest. My concern, though, with doing that is that people sometimes get all sorts of confused about the difference between their emergency fund and paying off their bond. Your emergency fund, you must keep remembering, is something that should be available to you, and it shouldn't be part of your paying off bond strategy, that you should be paying that off separately, because you still want to be able to access those emergency funds. Another question. Would we be able to get bridging finance if we don't owe anything on our current house that we would be selling, but it's not sold in time? Absolutely. There are a lot of people who offer that kind of bridging finance. In fact, the companies actually specialize in that bridging finance. My only warning is just be very careful of the interest rates that you're being charged on that. Sometimes they think you're a little bit desperate and they charge you a fortune. But certainly you can ask the bank for a bridging loan for that. Would you advise buying a house with my sibling as a joint bond, even if I know we'll be paying on my own and living alone in case I don't qualify? Okay. Joint bonds. Joint bonds are very problematic. A lot of people are doing joint bonds simply for that reason. They're worried they're not going to qualify. But first of all, if I was your sibling, I wouldn't want to take on that risk. To be perfectly honest, I wouldn't want to take on that risk of another person. What if you can't pay? That she or he would be completely and utterly responsible for the full mortgage. When you take out a joint bond, what people think is, I'm only responsible for 50%. No, the bank can go for you for 100%. I would want a really tight agreement about what actually happens. There's another problem that is the day that you want to transfer it fully into your name, the certain costs will apply. So yeah. One to enter carefully. Let me see, we're going to take a few more questions. Will a bank give a bank loan if you work for yourself and you don't have a permanent job? What do I need then to qualify? I feared you. I work for myself. And when we came to buy our home, in fact, the house that we live in now, I'm self-employed. My husband had a permanent job. They would barely consider my income, despite the fact that I had 5 years of SARS documents showing that I had a very steady income that grew every year, that I was resilient. They did not want to factor it in. I think they basically kind of applied about a 50% factor to my income. So it is very, very challenging. But what they will look at is generally your own bank is probably going to be the best to go to, because they will see your banking behavior. They'll be familiar with how much money you're making, the cash flow, your bank management abilities. But it is definitely more difficult for a self-employed person to get credit than an employed person. Let me see, I'm going to try and take 1 or 2 more questions, and then I'm going to have to wrap up. How about car finance? How do I get my bank to get my extra to capital, not interest? Okay, Martin, I've actually just finished writing an article about that, and I don't want to take up too much time here, but it's very important. So what you do with car finance is, if you're paying in monthly little installments, so say you're paying an extra 1,000 Rand, 1,000 Rand, it will accumulate in your advanced payments. Once those advanced payments reach 10, 15, maybe 20,000 Rand, ask them to capitalize it. They don't capitalize it every month. You do benefit from the interest because they offset the interest. But what you need to do is you need to wait until it gets to about 20,000 Rand, make a call, say, please capitalize the amount. But it is very confusing. It took me a very long time to understand how they do it. Okay, guys, so I think I've got through all those, most of the questions, and I'm really, really enjoying your engagements here. Oh, Patricia, that's terrible. You would like to pay towards a big debt caused by a family member using your details. Well, you also asked the question about the joint bond. I mean, it is, family are tricky. Family are tricky. Okay, so if we don't have any more questions coming through, then I'm going to have to decide, another 2 more questions. Then I'm going to decide on who the winner is of the book for today. So can you renegotiate your interest on your bond? Okay, I think I did deal with that. Absolutely. And I see your bond is with FNB. Yes, you can. You can. If you've got to have good reason to it, your credit record's got to be better. You have been paying. It's absolutely worthwhile. What is the capital gains tax story? It's the last question I'll do. What is the capital gains tax story on houses? Does it apply from house 1 or only if you have more than 1 house? Very important. Capital gains does not, well, it does apply to your primary home, but your first 2 million rand of profit is exempt. So you would have to have had quite a big growth on your property to actually pay capital gains tax. However, any property that is not your primary residence, capital gains tax applies from the 40,000 rand gain onwards. So anything you could offset, anything that you, so this would be applied to investment property. So obviously the purchase price, transaction costs, maintenance, you need to really keep a good record of what that property's cost you. So I think that's very important to understand. But thank you all, and I just want to let you know next week, I hope you're all going to join me next week, same time, same place, Thursday, 5 p.m., where I'm going to chat to you about personal loans. So today we spoke about home loans, personal loans, and when is it a good idea to take a personal loan out? How do you compare personal loans? Because I have picking up so many sort of thought errors around that. So I'm going to definitely cover that. I think my winner is going to be, I had an interesting one that I quite liked. The reason it was your, I got Marlene, my social media manager. She's hopefully scanning these for me as well, because there was somebody who put down a really good question or good goal. And I think the goal was paying off their car. The one who said they're going to pay off their car and use the installment for a property. So that's Labatu. Okay, you know why I'm going to choose you, Labatu, to win my book? Congratulations. Because it's understanding, when you come to buy a house and property, it's understanding the impact of all those other debts. Pay off your small loans, pay off your car, and get ready for home ownership. So Labatu, if you could just, my social media manager will DM you, and we'll make sure that you get a copy of this book. But of course, for those of you who are very disappointed you didn't win it today, you are welcome to join next week, same time, same place. Thank you to all of you.